All right, let's just jump right in because something really, really interesting is unfolding with MicroStrategy. We're going to break down how its entire financial structure is, well, it's evolving. It's shifting from what some saw as a theoretical model into what looks like a real, functioning piece of market machinery. So I want to start with a kind of a wild question. What if a stock's trading volume was actually more important than its price? Now, I know that sounds totally upside down, right? But the recent activity in MicroStrategy, MSTR, is basically forcing us to look beyond just the daily price chart and see this much deeper structural change that's taking place.
You see, the whole character of this system is changing, and I'm not just talking about a rally. What's really fascinating here is that for what feels like the first time, all the different components of MicroStrategy's capital stack, the common stock, the new preferred stock, and its Bitcoin collateral, they're all starting to work together like a well-oiled machine.
For the longest time, there's been this really weird disconnect. The company's underlying financial plumbing was getting stronger and more sophisticated, but the market narrative and the stock price just didn't seem to care. That's what's finally changing. The market is beginning to wake up and recognize the fundamentals, and honestly, that's the real story. Okay, so let's start with the first piece of this puzzle, the common stock, MSTR. It's been trading with just an incredible amount of volume. I mean, the kind of liquidity you normally only see in a mega cap tech stock. And this isn't just some fun fact for day traders, it is the absolute key to this entire model. Because in this specific system, that massive liquidity, it's not trivia. It's not just random market noise or churn. It's capacity. All that trading volume creates an enormous capacity for the company to issue new stock through what's called its at-the-market or ATM program. So what does that really mean? It means they can raise capital efficiently whenever a good opportunity shows up, letting them expand their Bitcoin holdings. Simply put, high volume equals a high capacity to execute their core strategy. And this right here perfectly illustrates the shift in perception. The old way of looking at it was that using an ATM offering was a sign of stress, a company raising cash because it was desperate. The new view, which the market is now starting to get, sees it as pure strategic execution. They're not raising capital because they have to, they're raising it from a position of strength because the window is open. Now let's move to the next piece of the machine, because this is where it all starts to connect. Meet STRC, the new preferred stock. And probably the best way to think of it is as the credit bridge in this whole model. It was designed from the ground up for stability and for scale. So the whole point of STRC is that it's engineered to do one job extremely well. Stay anchored right around its $100 par value and attract consistent, repeatable demand from the market. This creates a funding channel that acts a lot like credit. And, most importantly, it's a channel that doesn't depend on the crazy volatile sentiment of the common stock. And get this, in a single day, STRC traded over $200 million in volume. That's not a symbolic gesture anymore. That is a truly functional market with deep, real buying capacity. It's proof that there's serious demand for yield inside this new structure. But now, STRC is facing its biggest test yet. Okay, so it's already proven it can attract volume, check. It's proven it can hold its value, check. Now, it has to prove it can withstand that mechanical price drop on its ex-dividend date, and, this is the big one, it has to prove that the demand is repeatable, that buyers will come back long after the initial hype is over. And this quote it nails it. A one-time stock placement is just a transaction, but turning that stock into a durable, reliable product that the market returns to again and again, that is what elevates a company from just holding stuff to becoming a true credit issuer. That is the bridge STRC is trying to cross right now. Okay, so let's put these two pieces together. We've got MSTR, the liquidity engine, and STRC, the credit bridge. How do they combine to create this new digital credit model? So the old way of thinking about MicroStrategy was that the whole system was incredibly fragile. The idea was that it needed its stock to trade at a high premium to its assets. That premium was its oxygen. And if that premium ever vanished, well, the whole model would suffocate. But that way of thinking, it just doesn't seem to fully apply anymore. And this table here really captures that evolution perfectly. The primary goal has shifted from just protecting per share metrics to maximizing long-term funding capacity. Issuing stock isn't seen as this defensive, dilutive move anymore. It's seen as a foundational one. The whole structure is evolving from just a static pile of collateral into a dynamic, self-reinforcing system. This is the engine at the heart of it all. It's like balance sheet physics.
MSTR's liquidity is used to expand the collateral base to buy more Bitcoin. That larger collateral base then increases the capacity to issue more credit through STRC. Each part makes the other one stronger, creating this amazing loop that's driven by issuance mechanics, not just by price speculation. So, what's the ultimate payoff for building this whole intricate machine? It's a fundamental change in how the market sees the entire company, a shift from a question of survival to a question of scalability. And you can literally feel that shift in the market conversation. For months, the talk was all defensive, right? Dilution fears, premium compression, all these existential worries. Now, while those concerns haven't totally gone away, the whole tone is changing. The focus is slowly but surely moving towards scalability, capacity, and the durability of the model itself. Now, here is the really crucial point. Markets do not re-rate fragile systems. They re-rate durable ones. Before a company's valuation can really expand, the market has to believe its underlying structure is actually built to last. So the focus is shifting from the size of the price premium to the strength of the structural capacity. Durability has to come before the re-rating. So what should you be watching to see if this new model actually holds up? 3 key things. First, does STRC stay anchored near its $100 par value through this really critical ex-dividend period? Second, does that strong buying demand come back quickly after the price adjusts? And third, does MSTR keep up its outsized liquidity, which is the fuel for this whole system? If those conditions hold, it signals a monumental change. It means the dominant question is no longer if this digital credit model can work. The question is becoming just how far can it possibly scale? And that is a completely different conversation.